Welcome back to another episode of Bitfinex Talks. I'm your host, Ricardo Martinez, and today I'm very, very happy to be joined by Matt Black and Francis Corvino, who are both co-founders of Lygos Finance. And Lygos Finance is a platform that does Bitcoin lending for institutional clients and high net worth individuals. I'm very excited to have them on the show. Matt, Francis, how are you guys?
Amazing.
Yeah, great here as well.
Nice. So I'm super interested in Bitcoin lending right now because Wall Street is making a huge push into Bitcoin specifically and then crypto overall. And it seems like governments around the world are finally putting in like regulatory frameworks that are defining what businesses can and can't do in markets. And the situation looks pretty optimistic, and Bitcoin lending, I believe, is going to be like a huge market moving forward. Like, tell us what Lygos Finance is for those that aren't familiar with the project.
Matt, hit it.
I think so what Lygos is really is just a product that allows for folks to be able to get access to liquidity backed by their freedom money, right? So we believe that Bitcoin is the best asset that's ever been created in the history of humanity, and that really people should be able to get access to cash, to access to liquidity without actually going and selling their Bitcoin. The original, I remember back in the day when we were first getting into Bitcoin backed loans with my previous company, Atomic Loans. Back in the day, I was a poor college student, and at the time it was, hey, my landlord wants 4 months rent up front. How can I not sell my Bitcoin to be able to get that? Nowadays, people are looking to buy houses, looking to buy, a car or anything, and just not sell their Bitcoin. So that's really what Lygos is all about.
That's awesome. I remember early Bitcoin lending platforms being pretty risky. I mean, we've seen things like BlockFi and Celsius, which had a lot of people's money disappear in fiascos with Bitcoin lending. How are you guys like protecting your customers from outcomes like that?
Great question. So, and I think it's a perfect kind of interlude to explain what Lygos is from a sort of a level of bringing people together. On one side, you have Matt and Tony, who are from the former Atomic team. At Atomic, they were really the first team to bring discrete log contracts or contracts which are enforced by Bitcoin L1 mainstream. So they were the first people to really, introduce these, financial products on top of Bitcoin. Bitcoin native on L1 Bitcoin, no wrapping, no bridging, none of that. It's all just on layer 1 Bitcoin, right? They were really the team that championed that. On the other side of the house,
before you go forward, can we explain like what a discrete log contract is for someone that may not be so technical, and how it differs from like other arrangements like multisig?
Yes. Let me sort of back into it though, right? So we have on one hand we have a team which is just at word, right? Like the team which was the most focused on non-custodial financial products built on top of Bitcoin, right? Mm-hmm. And then on the other side, the other half of like Lygos that sort of came in as co-founders, we're actually folks from a lot of the kind of companies that you discussed earlier. We were at a company called Anchorage Digital. Jay and I, Anchorage Digital was the first national bank in crypto, and we were both on the lending desk there. What that meant was we were interfacing with a lot of these companies that you sort of just discussed, right? Like the BlockFis, the Genesises, the Celsiuses, the Voyagers, the Three Arrows Capitals. Like this list goes on and on and on. And while Anchorage was, honestly like very high quality, paid all of its lenders back in full, others weren't able to do that. And a large part of the reason that they weren't able to do that was because of stuff like fraud, right? So, maybe you were told that, hey, you have a $10 million loan from Genesis and you've posted $20 million in Bitcoin as collateral. Well, later on, you realize that Genesis or other companies were doing, random stuff with that Bitcoin. So you, in fact, thought you were borrowing from them, but they were really borrowing from you because, they had much more of your money than they had of yours. What Matt's product did and what sort of illuminated in our mind, having lived a very real experience of trusting counterparties and then realizing we should not have any trust in these counterparties at all, is Matt and Atomic Finance and these discrete log contracts allowed us for the first time to be able to have contracts on Bitcoin where we did not have to trust our counterparty not to rehypothecate our collateral. It doesn't matter if there's a legal agreement that says that they can't do it. It doesn't matter if there's a legal agreement that says they can do it. At the end of the day, there's mathematics and cryptography which enforce the fact that my counterparty cannot rehypothecate my Bitcoin, and it is not possible for them to repossess my Bitcoin, my collateral, unless the Bitcoin price has gone below a certain level. Now, how that works technically, I want to kind of send it over to the back of the house, but you sort of hit the nail on the head, right? Like half this team was focused on non-custodial financial products. Half of this team was focused on Bitcoin lending, right? And half of this team has experienced what it means to have really, really risky counterparties who rehypothecate and use your funds in ways which are, not what you would have expected and not what you would have hoped. The other half of the team brings the enforceability side, right? So I'll let Matt jump into that a little bit.
Yeah, I guess you asked like what is a DLC, right? Like what is a discrete log contract? Sounds really complicated. It's not really. It's really all it is just a very simple contract on the Bitcoin blockchain. It's really a way to do kind of a smart contract, but in a way that's extremely simple and extremely verifiable. So,
Okay.
If you take something like Lightning Network, you have two parties that go and enter into a channel, and they might go and update their state balances, and then they settle maybe at the end of the month. On the contrary, a DLC is similar in the manner that two parties come together in order to enter into a contract, but instead of them updating their state in the background, what they do is they lock their Bitcoin in a manner such that an oracle, upon maturity of that contract, can then attest to a real world event, which allows both of those parties to then unlock that Bitcoin. So this can be used for things like betting. It can be used for things like options contracts, futures contracts, and of course, Bitcoin-backed loans. Because if you think about it, what are the conditions for a Bitcoin-backed loan? I'm going to lock my Bitcoin. I'm going to get access to some stable coin in USDC. And either I'm going to get liquidated in the case that the price goes down below a threshold. I'm going to repay and get my Bitcoin back, or I'm going to not repay, in which case the Bitcoin gets repossessed anyway. And as a user, I can now go in there and I can go and verify, okay, here are those three possible outcomes. This is where the Bitcoin is going to go in those cases. This is the oracle. Okay, yes, I trust that oracle. I trust that they'll attest to that result, and then I can go and verify everything and enter that contract. And we make it super easy for folks to utilize DLCs. Yeah.
Okay, awesome. And then, I guess, how does a DLC differ from like a multisig contract that we see other Bitcoin lending things using?
Yeah, so it actually is. At its core, a DLC is actually a multisig. It is a 2 of 2 multisig, but the main difference is that rather than, so in a 2 of 3 multisig, what you would have, for example, is you would have, the borrower, the lender, and an arbiter.
Like an impartial third party, yeah.
Yeah, an impartial third party. And the arbiter is going to go and sign, either with the borrower or sign with the lender in order for some particular outcome to occur. One of the nice things with the DLC setup is the oracle doesn't even need to know about where that Bitcoin is locked or the existence of that Bitcoin. So it makes it a little bit more discreet, hence discrete log contracts, so that they don't actually need to know exactly where that is located. And the other thing as well is it just reduces the attack vectors, really, right? For example, the oracle themselves can only choose to, they only have a couple things that they're able to do ahead of time, right? They're only able to, if you pre-sign all these contracts, they can either, send it to the lender or send it to the borrower. They can't sign along with the borrower to send it to themselves or sign along with the lender to send it to themselves. So it basically just allows for everyone to set up what are all the possible outcomes ahead of time, and not really leave it to chance, or leave it to kind of the discretion of the arbiter, when the time comes.
Yeah, the arbitration is more programmatic, I guess.
Exactly. Yeah.
Fiat-minded people from traditional finance will counter Bitcoin-backed loans that are over-collateralized and say, eventually you're going to need paper Bitcoin or rehypothecation, for lending. Why do you guys agree or disagree with that viewpoint?
You know what's funny, Ricardo? I have an email from Zach Prince, from 5 or 6 years ago, before Atomic was Atomic Finance, we were Atomic Loans, and we were actually doing Bitcoin-backed loans, probably too early. But I remember we were writing a piece about BlockFi back in the day, and I got an email from Zach Prince that was basically like, yeah, you guys can write whatever you want in your blog post about the issues with rehypothecation and the issues with centralized lending solutions. Non-custodial will never take off. And that always just stuck with me, because I think that, it was so telling and so interesting that that was just the viewpoint at the time. But at the end of the day, the way that we see it is that, these rehypothecated solutions, whatever can go wrong will go wrong in the long term, right? So if you have a system where it's possible for, someone in the chain of, along the chain of lending, if you lend to someone and they lend to someone else and they lend to someone else, and anyone along that chain messes up and that causes the Bitcoin to be lost, eventually that will occur. Obviously one of the nice things here is that when you lock your Bitcoin as collateral, your Bitcoin stays exactly in that one position. And you don't need to worry about, coming back at, the end of the month and realizing like, oh, hey, does this company still have my Bitcoin at the end of the day? And so I think that's really the great advantage of this system.
Yeah, and one other thing I would say is, especially in a situation like a BlockFi, right? Like BlockFis, they rely on these things called bilateral agreements, right? So institutions would lend to another institution, and say you are one of their large scale counterparties. There's going to be a bespoke, simple agreement between the two different counterparties, right? That's what it's going to look like. Bitcoin is already capable of doing bespoke agreements between two separate counterparties. It can do that really, really well. So the only reason at this stage to not do something, non-custodially is because you want to rehypothecate. And I want to say that very, very clearly. At this point, Bitcoin is able to completely arbitrate two-party bilateral agreements on loans. The only reason to not use discrete log contracts is because you want to rehypothecate, or because you have some mandate to your regulator around exclusive control or something like that. There are situations like that. But at this point in time, Bitcoin is fully able to do bilateral contracts between two parties. And, again, the only reason not to do that is if you want to rehypothecate and you want to do something with that Bitcoin. And in the end, I think we saw, right, BlockFi filed bankruptcy, right? They were doing things with the customers' Bitcoin that they really hadn't, I would say that, the customers were hoping weren't going to happen at the very least. So it's whether by force or whether by sentiment, I think Zach is wrong, and people are going to be using non-custodial financial products.
Yeah, I mean, if you guys are correct and the market decides to employ these better solutions, like the market chooses a better technology, the ramifications for the lending industry are kind of staggering. Like how do you guys predict this playing out?
Well, I mean, the ramifications are staggering, but more than anything, it's like a change in behavior, right? So there is like the first order effects, right? Which are like, okay, now people are using these sort of discrete log contracts, or in other cases, maybe they do want to use like a 2 out of 3 multisig. But again, we believe that there's a lot of advantages to discrete log contracts specifically. But in either case, it's sort of a step in the right direction. So first, it's just an infrastructure thing, right? Like you need to get, whether it be the traders, whether it be the custodians, whether it be the exchanges, and anyone who might be a counterparty in a two-party deal, you need to get them integrated with sort of like, sort of the software stack, right? And then you have the second order effects, right? One is there's not going to be as much Bitcoin rehypothecated, right? So whether it just can't happen to some extent. So some people, of course, are still going to want to have a lower interest rate. So they might want to go somewhere where Bitcoin will be rehypothecated. But for those who don't want that and are currently having their Bitcoin rehypothecated because they don't know any better and they don't know that there's a better solution, for those folks, their Bitcoin's not going to be rehypothecated. So a clear second order effect is that sort of leaves the money supply, right? It's just, it's not going to be there to be borrowed against. So maybe a little bit less demand. And then the second thing is just like, I think longer cycles, right? What really brought down the 2023 cycle was like fraud and negligence, right? In particular the institutional sector. The market might have been a little bit hot, but like I personally think Bitcoin is hardwired for like 10 million, right? So whether it was high, it didn't seem too hot at the moment. Like the vast majority of the issues were like fraud and negligence. So I think as Bitcoiners and others start to like have a higher uptake rate in these products, we'll actually see sort of like longer, more steady market cycles. Yeah, I think that those are sort of the two predominant reasons. And again, like just because you have an on-chain agreement and on-chain enforceability doesn't mean you can't also have a legal agreement, which is binding, right? If you are an institution or a high net worth individual, you probably still want a legal agreement that says, hey, you know, you have to, like if something goes wrong here on the protocol front, right? Like you still need to make it right.
Yeah.
Now, is that perfect if I have to go ask them to make it right because I'm using a contract? No, it's not perfect, right? Like maybe they were able to liquidate too early. I have to now go ask them, or I have to go through the court system. And that's gives me some recourse, but it's not perfect, right? But it's pretty easy to do. I know exactly who my counterparty is. So they're really, again, you know, I don't think it's too many changes. They're really mostly behavioral and about the software and the availability of the software for people to use. But once the choice is made apparent, I think there's like very, very low opportunity lost in not having your Bitcoin rehypothecated. I think it's just a good thing.
Yeah, I would agree with you 100% there. For institutions that are just starting to dabble in Bitcoin and may not be like familiar, I guess, with the differences in Bitcoin lending, can you kind of explain like how your model contrasts with existing models?
Yeah, absolutely. So it's really about unilateral control over the collateral, right? Currently, if you are to take out an over collateralized Bitcoin loan, say you're posting $100 million in Bitcoin and you borrow $50 million in cash, the Bitcoin is sitting on the private key controlled by the lender. So in the 2023, you know, syndicate, right? You have FTX, right? They have one of those keys, and now they can go do whatever they want with their Bitcoin. Now, whatever the legal agreement behind the scenes says, no matter how comfortable that legal agreement makes you feel, at the end of the day, they hold that private key, which gives them the exclusive control to be able to move your Bitcoin. Our solution just does not allow them to have exclusive control until a Bitcoin price threshold has been breached, at which point, yes, the collateral is now in the exclusive control of the lender. But at that point, right, you didn't meet your margin call. You're under collateralized. So you're in a position where, in fact, you're not losing money, right? You shouldn't get liquidated. You might lose money on the liquidation, but it's not like, oh, I posted $100 million in collateral. They take my $100 million off and ran, and now I have $50 million in cash. I just lost $50 million, right? So for an institution coming into the ecosystem for the first time, the only difference between our solution and any other solution is our solution does not allow the lender to have unilateral control over the collateral. So if you want to borrow cash against your Bitcoin, or if you want your customers to borrow cash against your Bitcoin, and you don't want to worry about the platform that you decide to partner with running off with the Bitcoin, this is a really, really good solution for you.
Okay, awesome. And like where like institutions have these like strict guidelines where they have to be like accountable for custodying other people's funds, like how would like this type of trust minimized lending, like, I guess, improve or make more transparent, like these kinds of arrangements that we see?
Yeah, I mean, I think the most pivotal thing, again, just comes back to like, can they take your collateral or can they not take your collateral, right? These are bespoke, like for the most part on the institutional lending world, these are bespoke agreements between you and probably not like the bank entity or the trust entity itself, who have a lot of sort of mandates around how they control the collateral and what exclusive control means. Instead, you're going to have an agreement which is directly facing like maybe a special purpose vehicle or something like that. So they actually do have a good amount of flexibility. In general, with our type of solution, you can have a situation where you're facing a counterparty and maybe you don't have a legal agreement, but you can also, again, have a solution where like you have your traditional master service, master lending agreement, right? So again, it doesn't really look any different when you're borrowing. The only thing that is really different is the end result, which is the fact that they can't move your Bitcoin. But other than that, there is no real difference.
Okay, cool. And like, I guess how competitive are rates like with this kind of lending versus like traditional like
Yeah.
legacy lending models?
So, I mean, you get what you pay for at the end of the day, right? Like
Mhm.
there's an advantage to our specific company, which is that, you do have two folks here who have worked at the highest level of institutional finance within the Bitcoin cryptocurrency industry. So like anything else, we have access to kind of capital from the top of the funnel, which means that we can pass it on to our customers at a lower rate than a lot of companies in our situation can. So we're extremely competitive on rates. I think we'll actually be able to bring just about the lowest rates that a high net worth individual Bitcoiner can get anywhere. We're very passionate about bringing low rates to customers. But then at the same time, if you're going somewhere and you're allowing them to take your Bitcoin, rehypothecate it, borrow cash against that, and sort of go through that like loop of just continuing to try and make money off of your collateral, they're now able to use that to subsidize your rate a little bit, right? They're not going to give you all of the risk back and bringing your rate down from, maybe down 1% or down 2% or something like that. But they're only going to bring your rate down a little bit, right? And they're going to be making potentially a lot more money from being able to rehypothecate your collateral. So just because you see a low rate, I think that's probably the moment where you kind of want to have your ears start to perk up. You're like, oh, it's a really low rate. I'm getting I'm getting 7% on my Bitcoin. Like, you got to start asking yourself, like, why are you getting 7% on your Bitcoin, right? You only have to. You get to borrow cash at 7%. Like treasuries are like, I don't know, almost 5 now or something like that, right? Why is it so cheap, right? Well, the reason it's so cheap is because they're rehypothecating your collateral. The reason that they're coming in under market, which is at the end of the day the most important thing, right? Never mind where treasuries and so forth are. Like, what is the market? If they're coming in under market, it's because they're finding another way to produce money with your capital, and they're probably taking a lot of risk with it.
Out of curiosity, like, where are you guys based out of? Like, are you based in the US or somewhere else?
Yeah, well, so we're 50-50, right? Two of us are based in the US, and then two of us are based in Canada.
Okay,
So
nice.
North America.
Cool. And like, I guess from your vantage point of being kind of pioneers in Bitcoin lending, like, what kind of potential do you see for the Bitcoin lending market in the coming years?
Yeah, so this is actually one of my favorite subjects. I think that there's sort of 4 key categories where we see our customers borrowing cash against their Bitcoin and utilizing that cash. And I guess that's where I would take this. So like the first one is the obvious one, right? We've always had trade financing. There's been billions and billions of dollars of trade financing done. Galaxy came out with a report recently, which said that there was about $13 billion in borrow against over collateralized Bitcoin positions in centralized financial institutions. Like, it's already a big market. It can get a whole lot bigger than that. But that really is about like borrowing cash to buy more Bitcoin, which is a great use case. But I think that there's some more exciting ones on the horizon as well. Another kind of traditional one is for miner financing or like site development, right? You have a lot of Bitcoin. You want to go long Bitcoin, sort of trade financing again, right? You build a mining facility. Some people sort of do them as lifestyle things at this point. Some people just like mining Bitcoin. It's kind of fun. So there's those. But then there's sort of another category, which I think is beginning to emerge, which is really making me very excited, which is sort of like the great infrastructure projects of Bitcoiners. We have a lot of people who had the audacity to say, hey, I want to change the way in which money functions in society. These same people have now made themselves, frankly speaking, quite rich, right? Like Bitcoin is a top performing asset class over like the last decade plus. So if you were one of those people that had the balls, frankly, to say like, I'm going to change the financial system, why would you stop at changing the financial system? Why is that your endpoint? And I think we're already seeing it's not, right? Like, look at, Stacy and Max Kaiser, Herbert, right, in El Salvador. Like, they are really changing, they're changing the country, right? That is their goal. They have now a new ambition. They've already changed the financial system. Now we want to change an entire country, what it means for all these people, and we want to make it a paradise for Bitcoiners, right? I want to see someone, I listened to that Mammoth podcast with Joe Rogan recently. I want to see someone bring back the stellar sea cow in the Pacific Northwest via gene editing or something like that, like reintroduction of species. Whatever Bitcoiners' passions are, we want to see them use the wealth that they've created, which is substantial, right? Like, the Bitcoin market is now greater than the Manhattan real estate market. Imagine if the entire Manhattan real estate market was unleveraged for infrastructure projects and stuff, right? We're sitting in a situation like that where I feel like we're about to take that next step, and we're about to see Bitcoiners go from, hey, we've changed the financial system, right? There's definitely some things that we need to do in order to like make Bitcoin better for sure. And we never want to lose sight of that pursuit. But people definitely have other pursuits that they're beginning to pursue as well. Some of them I kind of want to keep under wraps, but we're really excited to support some of that stuff as well.
Yeah, it's going to be incredible. I think like right now we're already seeing huge changes to the world economy. Like, I mean, stable coins right now are about to like really become a huge thing now that they've been legitimized through regulation, and like institutions just entering Bitcoin and other digital assets as well is going to have a huge impact. Like, I guess, do you guys see any other assets aside from Bitcoin with the potential to also be like an asset that people look towards these kind of lensing solutions for, like Ethereum or I don't know, Solana, something like that?
It's not going to be us.
Not going to be.
I've done like work when we were in the Atomic Loans days. We were doing like smart contracts on, half of our product was on Ethereum with stable coins, the other half was on Bitcoin. And I think one of the big challenges is the surface area of attack that exists with these other coins, right? Like, if you're taking out a Bitcoin backed loan and you're locking in a DLC, there's a lot of security and a lot of just a high level of confidence that you can have that you're going to be able to get that capital back. Whereas, just the amount of surface area of attack that exists in smart contracts is just so much larger that it's much more difficult to have that same level of reliance. So for us, we want to make sure our users are using the thing that's the most battle tested and the most secure.
Yeah. So while we are going to focus on Bitcoin script specifically, we can kind of break your question down because you asked about other coins. So when it comes to other coins, only Bitcoin is money. I think that's very clear, and other coins exist out there and like they're kind of doing stuff, right? Like they're not for me. Where there is some interesting technology which has been produced is, for example, in virtual machines, right? Virtual machines are quite dangerous because there's unbounded risk. You can never test all the potential inputs against all the potential outputs. In comparison to Bitcoin, where you can, with Bitcoin L1, script is so simple that you can take every potential input and test every potential output. So that juxtaposition and that, increased security threshold is where we feel most comfortable. We do believe, specifically to virtual machines, there are things like money markets, which can be made with them in the future through things like BitVM, which are valuable. But when it comes to like high value, super security, like no bridging, no staking, no like additional risk vectors, we believe that sticking to Bitcoin script on layer 1 and sticking to Bitcoin is the best route for us.
I think that's a great way to close out the interview. We're running out of time. Do you guys want to give your website out and any social media links or say any last final comments before we end the interview?
Yeah, I would just say we're Lygos.finance on the internet, and Twitter wise, you'll definitely be hearing from us. We're moving the Atomic Twitter account to the Lygos Twitter account as we speak. This is some alpha, I guess, for Ricardo. We'll be doing some teasers, which in retrospect will probably be quite obvious. But yeah, I mean that's I think where to find us for now. And then at Matt Black on Twitter for Matt, right?
At Matthew J. Black. Yep.
At Matthew J. Black on Twitter for Matt, and then at Stark and Lime for me.
Okay, cool. Well, I'm very excited about what you guys are doing. Your project is super inspirational. I am more Bitcoin centric as well, so I agree with you on focusing on Bitcoin. Amazing work, guys.
All right. Thank you so much.
Thanks.